The dollar doesn't usually bend like this unless something underneath the surface is shifting. And right now, the currency layer is doing something markets only do when confidence gets tested. DXY, the US dollar index, has been sliding toward the mid-90s zone after a long stretch where the dollar was treated as the default safe trade. Let that sink in. The benchmark for the reserve currency is acting less like a fortress and more like a pressure valve. And when the reserve currency weakens, the pricing engine for global commodities changes because oil, copper, wheat, gold, silver, all of it is still mostly priced in dollars. A softer dollar makes those assets cheaper for non-U. S buyers, yes, but it also sends a deeper signal. It hints that policy risk is rising. It hints that real purchasing power is being questioned. It hints that holding currency by itself might not be the cleanest form of safety anymore. That's why gold and silver start moving before the crowd understands why. Gold has pushed into a new regime, not a gentle climb, not a tidy trend, a re-rating. Silver has followed with the kind of move that forces people to relearn how this market behaves. The important part isn't the headline number. The important part is what the move represents. Because precious metals don't move on vibes, they move on math. They move on real rates, meaning interest rates after inflation. They move on currency trends. They move on liquidity. They move on positioning in futures markets. And they move on physical tightness when buyers decide they want metal now, not later. That last part is the one most people underestimate. Gold and silver trade in two worlds at the same time. The paper world and the physical world. In the paper world, there are futures contracts, standardized agreements to buy or sell metal at a later date, traded on exchanges like COMEX. Most of those contracts never result in physical delivery. They're traded, hedged, rolled, or closed out. In the physical world, there are bars, vaults, refiners, mints, industrial users, and wholesalers, networks like the London bullion market where metal is stored, moved, leased, and delivered. When those two worlds are calm, prices behave. Spreads stay orderly. Physical premiums don't scream. The system looks boring. When those two worlds start disagreeing, when physical buyers get more aggressive while futures traders are repositioning, that OS, when price action turns sharp, that's when gold stops being that conservative hedge and starts acting like a signal. That's when silver stops being the cheap metal and turns into a volatility event. Here's what needs to be understood. Contango and backwardation. Contango is when futures prices are higher than spot prices. That's normal for many commodities because it reflects storage, insurance, and financing costs, the cost to carry. Backwardation is when spot trades above futures. That is the market saying something simple. Demand for immediate supply is stronger than the incentive to wait. Backwardation is not a guarantee of a shortage, but it is a stress signal. It was the market whispering, sometimes shouting, that near-term supply is tighter than the system likes. Now connect that to silver. Silver is a monetary metal, and it's an industrial metal. That dual identity is why it can look quiet for years, and then suddenly act like it was coiled under tension the whole time. Industrial demand matters because silver is used in high-performance applications, including electronics, medical, and solar. And when the price of silver rises fast, it does something that's easy to miss. It squeezes manufacturers. When a commodity becomes a large share of production cost, companies don't just complain, they redesign, substitute, or reduce usage where possible. That can eventually cap demand growth, but in the short run, it can also create urgency, because factories still need material, supply chains still need delivery certainty. Production schedules don't pause politely while markets cool down. That's how demand picks up even when prices are already elevated. It's not always new demand. Sometimes it's demand being pulled forward. And in silver, forward demand can matter a lot because the market is smaller than people assume, and the buffer between availability and consumption can be thinner than the narratives suggest. Now bring gold back into the frame. Gold plays a different role. Gold is less about industrial necessity and more about monetary credibility. Gold is the asset with no counterparty risk, no promise to pay, no default risk, no earnings requirement. It's collateral that doesn't need permission. That's why in regimes where policy uncertainty rises, where inflation expectations become sticky, where fiscal debates get louder, where geopolitical risk doesn't stay local, gold becomes an anchor, not because the world is ending, but because the world is repricing. And repricing is enough. A lot of people still think of gold demand as a niche story. Central banks here, jewelry there, a few investors on the margins. But when broad investment demand turns on, it doesn't arrive gradually. It arrives in waves. It shows up in ETF flows. It shows up in institutional allocation decisions. It shows up in the way dips get bought. And when gold holds strength during periods of dollar pressure, it reinforces a simple message. Someone, somewhere is hedging credibility. That's the macro connection. Dollar pressure doesn't just change exchange rates. It changes behavior. A weakening currency encourages commodity allocation because it's a hedge against dilution. It also encourages diversification because concentration risk starts to feel expensive. In a world where the dollar is less stable than the last decade trained markets to expect, hard assets start feeling less like a trade and more like insurance. Now, the historical parallel matters here, not because history repeats perfectly, but because it teaches how these markets punish certainty. In late 1979 and early 1980, metals became a pressure valve for inflation fear and confidence breakdown. Silver went vertical, and then it collapsed with stunning force. In 2011, silver surged again, and then the unwind was brutal. A lot of people learned the same lesson twice. Silver can move like a leveraged version of gold on the way up, and like a trapdoor on the way down. That's why the current moment has to be treated with respect. Because when silver moves fast, it's not just price discovery, it's positioning discovery. It reveals where leverage is hiding. It reveals where hedgers are under pressure. It reveals where the market is thin, and thin markets can do violent things. Here's where it gets really interesting. The psychology of a century mark. When silver trades near 100, something shifts in perception. It's not rational, but it's real. Round numbers become magnets. They become storylines. They become anchor points for human behavior. Holding above 100 can invite momentum traders. Slipping below 100 can trigger risk-off behavior and forced unwinds. The number becomes a hinge, and hinges swing both ways. Now, the bearish case has to be real, not performative. There's a scenario where the dollar stabilizes, where risk assets rally, where real yields rise, where liquidity tightens, and metals cool off. There's a scenario where silver demand destruction accelerates, especially in cost-sensitive industries, because substitution and thrifting intensify as prices stay high. There is a scenario where futures market leverage unwinds and silver drops in a way that feels unfair, because silver does that. It does not apologize. There is a scenario where intervention risk rises, not necessarily direct, not necessarily dramatic, but through margins, liquidity rules, and market structure changes that force positioning to shrink. And there is a scenario where a pullback is not a gentle reset, but a violent one. That possibility has to be acknowledged, because it's always on the table in silver. But here's what those risks don't change. They don't change the fundamental reason gold holds a bid in currency, uncertain regimes, credibility hedging. They don't change the structural tension in silver when monetary demand overlaps with industrial necessity. They don't change the fact that the dollar is a baseline driver for commodity pricing, and persistent dollar pressure tends to keep the metals thesis alive longer than skeptics expect. This is not a market that needs perfect conditions. It needs persistent conditions. A soft dollar for long enough, real yields that don't compensate enough, inflation expectations that don't fully cool, geopolitical noise that doesn't fully fade, supply chains that value certainty. That persistence is what pushes demand from optional to urgent. So what should be watched next? Not as instructions, not as a promise, but as a framework. Watch the dollar trend, not day to day, but in sustained direction. A weak dollar can keep supporting metals even when the chart looks overextended. Watch gold's behavior on risk-off days. If gold holds firm when markets wobble, it's telling a story about hedging that goes beyond speculation. Watch silver's ranges. When daily ranges widen, it's a volatility warning. Big candles are not just excitement, they're stress. Watch physical premiums and availability where possible. When physical tightness increases, it shows up in the real economy, not just on a screen. Watch future structure and delivery dynamics. Registered versus eligible inventory matters, because registered is the portion designated for delivery. And when that buffer feels thin relative to paper claims, the market becomes more sensitive to delivery interest. And above all, verify independently. Look at the dollar index. Look at the gold and silver settlements. Look at major vault and exchange data. Compare multiple sources. Be skeptical of anything that sounds too clean, too certain, too absolute. Because markets are rarely clean. They're messy. They're human. They overshoot. They mean revert. They punish crowd certainty. Now, the implications depend on who's listening. For long-term holders of physical metal, the focus is usually purchasing power over time, availability, and the ability to stay patient through volatility. For active traders, the focus is risk control, because leverage and volatility do not forgive bad sizing when the market gaps. For long-term investors, the question is whether the world is shifting into a regime where currency credibility is a bigger variable than it used to be, and whether diversification into hard assets becomes a rational response to that regime. And for anyone new to this space, the most important lesson is simple. Don't confuse a powerful move with a guaranteed outcome. Silver especially has a way of making certainty expensive. Full risk disclosure. Gold and silver can be highly volatile. They can move sharply on macro headlines, liquidity events, and positioning shifts. Leveraged products can magnify losses. Nothing here is financial advice. There are no guarantees, only scenarios, probabilities, and risk management. So the core message is this. Dollar pressure is building, and that pressure changes the behavior of the entire system. Gold is responding like a credibility hedge. Silver is responding like a stress test, part monetary, part industrial, and fully capable of extreme volatility. And the next phase will not be decided by loud opinions. It will be decided by whether the currency trend persists, whether real yields stay constrained, whether physical tightness remains relevant, and whether demand continues to shift from optional to urgent. Because when confidence weakens slowly, markets adjust quietly. But when confidence weakens enough, the adjustment stops being quiet and the price starts doing the talking for everyone.